The assets we possess, ranging from bank accounts to brokerage and cryptocurrency accounts, are primarily represented as numbers in a digital realm. If everyone were to rush to their bank simultaneously demanding their funds, the reality is that the banks wouldn't be able to fulfill those requests, as they operate with minimal reserves. A case in point is Coinbase, the largest cryptocurrency exchange in the U.S. If it were to declare bankruptcy, users could potentially lose all their holdings. This situation highlights a broader issue. The stocks we believe we own are merely digits on a screen, as physical certificates are a thing of the past. Unlike these intangible assets, physical metals represent tangible wealth that you can possess without the risk of counterparty failure. This distinction is crucial, especially as economic conditions become increasingly unstable. To visualize this, consider the U.S. dollar is water in a bathtub, with gold and silver resting on the edge, symbolizing a more stable form of wealth amidst the uncertainty. The situation with currency is akin to a bathtub filled with water. When you pull the plug, the water level begins to drop, much like the value of the dollar. The decline in the dollar's worth does not indicate that gold and silver are increasing in value. Rather, it highlights the diminishing value of the dollar itself, which is on a troubling trajectory toward worthlessness. A historical example can be drawn from the Weimar Republic in Germany post-World War II, where individuals would transport wheelbarrows filled with banknotes just to purchase a loaf of bread, only to return to find their currency discarded and their wheelbarrow stolen. This illustrates the critical point that the ultimate decline of the dollar will determine the significance of gold and silver, which have symbolized enduring wealth for millennia. In times of economic uncertainty and speculation, the importance of owning gold and silver has never been more pronounced. I firmly believe that the era of the dollar as the sole global reserve currency is nearing its conclusion, especially as we witness countries like Saudi Arabia, Nigeria, and Russia engaging in trade with China using alternative currencies. The recent actions, such as the exclusion of Russia from the SWIFT system and the broader implications of the dollar's diminishing influence, further underscore this shift. The dominance of the dollar as the primary currency for energy transactions, particularly oil, signals a significant shift in the global financial landscape. We are witnessing a gradual departure from the dollar's supremacy as the sole world reserve currency, particularly in the context of the petrodollar. The moment a PTC announces its decision to accept payments in various currencies, influenced by the backing of nations like Russia and China, will mark a pivotal turning point. When that occurs, a massive influx of dollars returning to the U.S. could trigger hyperinflation, exacerbating the current inflationary pressures. The potential fallout would be severe, with interest rates soaring and the values of stocks, bonds, and real estate plummeting simultaneously. The fate of the dollar rests heavily in the hands of the Saudis. Should they choose to pivot towards alternative currencies for oil transactions, it could spell the end for the U.S. dollar. In such a scenario, the significance of tangible assets like silver will rise dramatically, as the dollar, along with other fiat currencies, faces inevitable decline. The current fiat system, lacking any substantial backing, is increasingly seen as unsustainable, and I firmly believe we are approaching the conclusion of the dollar's era as the singular world reserve currency. When considering wealth, gold and silver stand out as tangible assets that should not be subjected to speculation. The reality is that when a currency loses its appeal and becomes undesirable, the ownership of physical precious metals gains significant value. This is not merely a means to accumulate wealth. It embodies wealth itself, especially during times of dollar uncertainty and geopolitical turmoil, which have never been more pronounced. My approach has typically been to maintain a balanced portfolio of 50% in dollars, but currently, I believe silver presents a more attractive opportunity. With the gold-to-silver ratio hovering around 82 or 83 to 1, there is a compelling case for accumulating silver now and later trading it for gold when the ratio normalizes, as it historically averages 42 to 1 over the past 2 centuries. Given that silver is being mined at a ratio of 7 to 1 yet is priced at 83 to 1, it is significantly undervalued based on its geological availability. Therefore, I recommend a heavier investment in silver with the plan to transition to gold once the ratio adjusts. While many may disagree, and some may advocate for silver as the ultimate investment, The recent reclassification of gold as the only other Tier 1 reserve asset reinforces my belief that gold should ultimately hold the majority of one's investment, albeit not until the ratio shifts favorably. In 2010, I launched my first podcast, which coincided with a remarkable gold-to-silver ratio of 85:1, marking only the second occurrence of such a high ratio in human history. I advised everyone to convert their gold holdings to silver, and within 8 months, the ratio shifted to 37:1, with silver reaching $50 an ounce, placing us in a unique historical context that has only been seen a few times over the past 5,000 years. The current global mining ratio stands at 7:1, as silver is typically found in epithermal deposits close to the Earth's surface, meaning that significant reserves were discovered long ago. Given that silver is priced at 83:1 while being mined at 7:1, one could argue that silver is significantly undervalued, potentially by a factor of 12. The question of timing for investment is complex. Ideally, one wouldn't want to wait until the ratio aligns with its geological norm of 7:1. However, any time the ratio approaches its 200-day average of 42:1 presents a lucrative opportunity for doubling one's investment. Essentially, if you possess an ounce of gold, theoretically, you could exchange it for 83 ounces of silver, and as the ratio nears 41.5, you would effectively double your initial investment. While I believe gold remains a solid investment, silver serves as a strategic means to accumulate more gold, and owning a substantial amount of silver could lead to significant wealth. The only caveat this time is that achieving wealth through silver might come at the cost of a rising dollar against gold. Silver functions like the water draining from a bathtub, illustrating why I refrain from discussing gold and silver as tools for wealth creation. Rather, they serve as wealth preservation. They maintain your purchasing power, which is paramount, even if the dollar we compare them to is flawed. The dollar may be the least unattractive option among fiat currencies, but if another nation were to announce a new digital currency, such as a digital yuan backed by gold, where Brazil, Russia, China, India, and South Africa collectively peg their currencies to a substantial gold reserve, the dynamics would shift dramatically. This new digital currency, supported by the reliability and transparency of a distributed ledger, would attract global interest, as it offers stability and strength compared to a system burdened by $130 trillion in debt. This scenario underscores the importance of owning gold and silver to reduce your exposure to the dollar, regardless of whether you hold more silver or gold. The key is to safeguard your financial position.